What's the first thing professional traders and investors check every morning? Not their individual stocks, but rather market indices. If you are trading or investing in stocks without understanding terms like the S&P 500, NASDAQ, Russell 2000, and so on, you're missing critical information that could have been used to make money. In this video, you will learn what a stock market index is. You will learn about the different indices, how they work, and why they are so important. But alright, so let's begin here by answering the very important question: what is a stock market index? Well, in simple terms, a stock market index is a measure that tracks the performance of a group of stocks. And this group is representing a particular market or segment of market. So for example, the S&P 500 that we will talk about more later, as we can hear on the name, tracks 500 stocks. So if the S&P 500 goes up 1%, it basically means that these 500 stocks have gone up 1% on average, or that's a simplified explanation. We will talk more about that soon, but I hope you get the gist of it. So instead of following hundreds of individual stock prices, an index gives you one simple number that summarizes how this collection of stocks are doing. But right, so how does indices, or I think you also can say indexes, I'm not really sure, but indices is the common word. How does this work? Well, each index has a specific list of companies. You can think about this as a basket. So each index is a basket here with multiple companies or multiple stocks inside the basket. And when those companies' stock prices move, the index moves. If most stocks in the index go up, the index goes up, and so on and so on. But now you might of course wonder, why does indices exist in the first place? Well, here are the main reasons. First of all, and this one is pretty clear, it simplifies market tracking. So here we have one number instead of, having to track hundreds or maybe even thousands of stock prices. Another reason is that it's a measure of market performance. So you can gain direct insight into market trends. For example, if you wake up in the morning and see that the S&P 500 is down, let's say down 2%, you know that, the market is very bearish right now. You can also use indices to create investment products. So there are multiple products, like for example ETFs, that you can use to invest in entire indices. So you can, for example, buy the whole S&P 500. If you want to learn more about ETFs, I do have a video about that, and I will make sure to link the video somewhere up in the corner and the description of this video. Last but not least, you can use indices as a benchmark for comparison. So it provides basically a standard value that you can use to compare. So for example, let's say you have a stock, let's say you own Nvidia, and you see that Nvidia is up 5% while the S&P 500 is only up 2%, then you know that Nvidia is outperforming the market today. So here, investing in indices. As I just mentioned, you can't really buy an index directly. It's basically just a measurement, but you can invest in, for example, index funds and ETFs. And as I said earlier, I actually highly recommend to check out my video on ETFs. But now then, how are indices built? Well, they can differ a bit on how they are calculated. So they use basically different weighing methods, and they can also be different in what stocks they include. So what metrics do they have to include a stock in a certain index, and so on and so on. So right here, you can dive even deeper into how indices are calculated and so on and so on. But I do think I will save this part of the presentation for channel members. If you didn't know, we have an amazing community here on YouTube where I post presentations like this one. I also post exclusive videos and lots of bonus material. And at the same time, you support the channel. So If you want to get access to this full presentation, consider becoming a channel member today. But as I said, I will save that part for channel members because that's a bit more advanced. But now I want to move into something very important, and that is the most important stock market indexes in the US. So let's take a look here at the most important ones. And the first one that we have to talk about, and this is the most important index in the whole world. This right here is the S&P 500. And why is this one so important? Well, it basically tracks the 500 leading large cap companies in the US. And large cap basically means the most valuable companies in the US. And this index is market cap weighted. So bigger companies move it more. So if we have a very big company like Apple, and let's say Apple moves up 1% compared to, let's say, a much smaller company, I don't know, maybe, Intel, INTC. If Intel moves up 1% versus if Apple moves up 1%, Apple will have a much larger positive impact on the S&P 500 because Apple is larger. This is basically what market cap weighted mean. And here the S&P 500 covers around 80% of the total value of US stocks. So right here you can hear why the S&P 500 is so important, and it's widely used as a benchmark for investors and funds. So many traders, for example, will look at the S&P 500, the performance, and if the trader is performing better than the S&P 500, that's in general very good. But if you perform worse than the S&P 500, maybe you need to look over your strategy. And you can basically think about the S&P 500 as the all-star team of the stock market. These are the creme de la creme of the stock market. The next index I want to talk about, which is also very important, is the NASDAQ. You have probably heard about the NASDAQ, but what is this index? Well, this index includes over 3,000 companies listed on the NASDAQ exchange. And this index is also market cap weighted, but it's heavily skewed toward technology. So NASDAQ, when you look at NASDAQ, that is more like, you can think about it as the technology index in the US. So this index is dominated by, for example, tech giants like Apple, Microsoft, Amazon, Google, and so on and so on. And this one serves as a barometer for tech and growth companies. Think about it as the tech pulse of the market. Here are two more honorable mentions. First of all, we have the Dow Jones, or for short, the Dow 30. This one is only 30 large US companies, so it's a much smaller index compared, for example, the S&P 500. And this index is price weighted, not market cap weighted. And the reason the Dow Jones still is so important, or I would say a big reason, is because it's such an old index. It has been around since 1896. So you can kind of think about this index as like an exclusive club. In my opinion, not as important as the S&P 500 and NASDAQ, but definitely an honorable mention. And many traders are actually focusing on the Dow Jones. Another index we of course have to mention is the Russell 2000. This is a much sort of smaller index, or it actually contains more companies than, for example, the S&P 500. As you can see, the Russell has 2,000 companies, but these companies are much smaller. And this index is market cap weighted, and the key here is that this is a small cap benchmark. So if you want to know how the sort of smaller stocks have performed on average, definitely have a look at the Russell 2000. You can think about this if you want to as the farm league of companies. So right here is a quick list of the different indices, the weight, the focus, and so on and so on. Feel free to, take a screenshot of this right here. Or if you, as I said, if you want to get access to this full presentation, I will post it for all channel members. All right, so now guys, let's jump into TradingView, because now I want to show you guys how to find these different indices in TradingView. And of course, by the way, if you for some reason haven't gotten started with TradingView yet, I do have a special link that you can use to get TradingView Premium for free for 30 days and also a $15 bonus. But to find the indices in TradingView, you simply go up here to the upper left corner where it says symbol search, and you can either go to all here and search, manually. So let's say we want to find the S&P 500, you can search for SP 500, or you can simply go to the indices tab right here. So you press indices, and here you can see a list of some of the largest indices. But now let's say we want to open the S&P 500, and here we can search for US 500. So this is a sort of simplified, or this is basically the S&P 500, but the calculation method is just a little bit different than the official index, but this one is pretty much the exact same thing. So for example, right here, I'm currently looking on a daily time frame. So every candlestick you can see here on the chart represents one day. And you can see that today, the S&P 500 is trading down around 0.10%. We are at the day low. But if we instead take a look at, let's say we want to open up NASDAQ, then we can search for US 100. Let's open up NASDAQ. You can actually see that the NASDAQ is down a little bit more. Today, the NASDAQ is down around 0.4%, while the S&P 500 is only down 0.10%. But most importantly, let's actually take a look at the Dow Jones 30. So we search for US 30, and as you can see, Dow Jones 30, we open it up. You can see that here, Dow Jones 30 is actually down much more. We're down around 1.6% on the Dow today. So I hope this short demonstration can show you guys how different stock market indices can actually differ a lot. But alright guys, so now if you want to be able to invest directly into stock market indices, I highly recommend to check out this video about ETFs next. I hope to see you all over there, but for now, take care. Ciao, ciao.